Hey, how's it going, guys? This is my show. This is the Andrew Money Show. That's my book. That's my dog. These are my emojis. And here is how you guys can focus up and learn the trading strategy to start the squeeze. You guys want to start the squeeze, right? Well, you guys better pay attention until the end and thank Stephen Christopher Heinrich as the person I want to shout out. That is a great supporter of the show right now. Here we go. Not a moment to waste. If you guys are worried about the squeeze, you're seeing a lot of red on GME and AMC, don't worry, there is hope. Here is how we want you to focus up and learn a trading strategy. Now that said, even when you learn this trading strategy, do not implement it as financial advice. Do not take anything I say as financial advice because I am not a financial advisor. Just a friendly neighborhood ape here to give you some smooth-brained advice. So, first comment about this, okay? I've seen a lot of bullish technical analysis on GME. Keep in mind, all TA requires volume to play out how it should. We haven't had any volume on GME in over a week, and that is true. We had roughly 20 million. That's half of what we usually get the week before, and that is the week before. We're expecting a lot more volume this week, especially as quadruple witching day comes closer and closer. Holding shares simply isn't enough. We need constant all day, every day buying of shares and in the money options. Okay, now temper this with remember, this is not financial advice. And if you are just holding tight, hey, some of you can. Those of you who have stayed diamond throughout this entire process, thank you guys. We appreciate it. And onwards we go with the not financial advice. If you buy options that are 20 to 30% in the money, they literally can't price pin because they can't get and keep the price 20 to 30% below current market. So you force immediate share buying by market makers to hedge and virtually eliminate their means of counterattack, which has the price pinning at the point of maximum pain, price at which most contracts expire worthless. Talk about contracts expiring worthless. Let's talk about the God Pill video if you guys haven't seen it yet. It's Moon Jesus helping us out with $1.5 million that he made with options and then having $200,000 worth of contracts expire worthless every week for 3 weeks, fighting the good fight. If you are intending to help push the squeeze, buy shares throughout the day, every day. If you are playing options, mostly buy calls in the money. If you're buying out of the money calls, buy as close to the current price as you can afford. The more imbalanced out of the money calls are, the more they're just going to price pin at maximum pain. They literally cannot do this if there's a ridiculous amount of new in the money call interest that they have to buy shares to hedge. And we've talked about delta hedging in the past, and you guys know that that's the idea that when you buy an out of the money call, the closer you get to in the money, the more likely that the hedge fund is going to have to buy the shares before it gets to your strike price. That's just going to cause some upwards force to drive the price up. Now, essentially, we cannot, hold on a sec. Yes, we cannot rely on normal techniques to technical indicators for movement with GameStop. There are now two major reasons why. One, manipulation. We cannot do anything about this really aside from buy and hold. Technicals actually have a tendency to work in reverse when a stock is being manipulated at these levels. The shorts, while stuck in this stupid position, aren't stupid. They know that when the technical analysis is indicating a bullish setup and that this is the best time for them to attack the stock to break the setup. Okay. So this is essentially Sun Tzu Art of War, know your enemy. When they know that we are feeling bullish, they will go in and attack. So be careful with normal fundamental analysis. We've already said this is no longer a fundamentals game. All right, number two, volume. All technical setups require volume to play out. If volume doesn't follow, the technical setup fails and the price action is unpredictable. Except in this case, it goes down because it's being shorted at every chance. So there are indicators like the moving average convergence divergence chart that we have right above my head. It's this histogram and this blue and orange line. At times, it does seem to be correct, especially with AMC yesterday, right before the breakout from $11 to $14. It saw some significant rise of the MACD line above the signal line, which meant, hey, we were bullish as heck and it worked. However, with a GME, this MACD line is crossing the signal line right here at around 9:50 a.m. EST. And if we bought here, you would be trading sideways and then downward. It just doesn't seem like the normal technical indicators are working as intended. So what do we need to do? Well, hold? Yes, but that can't be it. If we're doing nothing but holding, this will be a stalemate that they will probably win as sections of retail gets bored or impatient. They can literally hold us in a stalemate for months or years if volume never shows up to move the price. yes, they can pay more interest the longer they have to wait. However, they'll just manipulate other sectors of the market to force gains and cover their losses unless the SEC steps in to stop market manipulation. Hint, hint, SEC watching this video right now. Volume. So without volume, there is no end game. Look at every day we've had so far. That we've had spikes. Look at the volume. Now look at the past week or two. We aren't making progress because nobody is buying shares. What's up, Michael Jones? Thanks for joining the Mo Monkey Army. Let's see. Aside from some whale algos that are simply fighting off the short attacks, believe it or not, the whales do need retail support to force the squeeze. That's hard to believe. So I will let you make your own decision about this DD. Do the whales need the retail sellers? The whales are the ones creating momentum from time to time. If it catches on, they can follow it up. But if they just go all out to create a surge and nobody follows behind them to buy, they are literally risking billions of dollars to fail. And that's all of us, guys. Retail investors are trying to slam dunk after the alley-oop. The first thing will likely happen in waves over the course of a few days. If you look at any day, there are surges in buy volume, but they're short. That's likely a whale testing the market. If they are confirmation follow-up from the market, it's less risky for them to send a second wave of buying pressure. Essentially, this is the same as Pixel Josh's DD, that essentially some friendly whale is doing a mini boss right now. They throw up the stock and they say, hey, sorry, I said throw up because I'm still doing the basketball analogy. They throw down the stock. They push it all the way down and say, hey, does this scare you? Because if it does, I'm not going to buy in. I'm just trying to see whether or not you guys have the mettle to buy the dip. Can you buy the dip, or are you too afraid? Let's see. All of those things have to happen consecutively, fluidly, and fairly quickly to beat any kind of counter attack. What's going on? Let's see. Now this is going to sound counterintuitive, but in order to catalyze the squeeze, we have to stop just buying the dip. When volume picks up and price is peaking, that's the most important time to buy. That's the point when additional buying pressure is most important, and until the retail market confirms pressure on one of those spikes, we're going to keep bouncing back and forth. And that kind of makes sense, actually. If the price gets really high and people are starting to worry that this is overpriced, if you continue buying, that confirms that it is not overpriced because someone keeps buying. It's like an expensive movie theater. They might end up changing the price of water if no one's buying at $10. But if you go in swagging up nice Versace duck shirt and you say, give me 20 waters, and you just bought $200 worth of bottled water at a movie theater, they're going to keep that price right there, if not higher. That's exactly what we are hoping for. Options. The other side of the coin is options purchases. Hold on a second. Stop devoting the majority of your capital to far out of the money lotto tickets, right? This helps the short positions because it forces market makers to help the shorts. Market makers that sell call options have to hedge their risk. When you buy an $800 call, it does two things. One, they don't have to buy very many shares up front to remain risk neutral, and two, it incentivizes the market makers to pin the price. You can do some additional reading on max pain price in options, but essentially the closing price at which the largest number of options expire worthless when you buy an out of the money call option, which just means that you buy a call option with a strike price higher than the price that currently is. You're predicting that the price is going to go higher than it actually is right now. You're increasing the maximum pain price, which makes it easier for market makers and shorts to pin the price there. If, however, you're buying a ton of in-the-money call options, you're doing two things. One, deep in-the-money calls have a delta of essentially 1. That means that in order to remain risk neutral, the market makers essentially have to buy 100 shares immediately upon selling you the contract. 2, it lowers the max pain price by creating an imbalance towards lower strikes having the most OI. This means that in order to pin the price at max pain, they would need to drop it from its current price. So not only do you force market makers to risk neutral immediately, meaning they don't care where the price goes, you also force them to immediately put buying pressure on the stock price. If you must buy out of the money calls, buy ones that are at least close to being in the money. The further out of the money you buy, the more likely the price will go sideways. You can also sell calls and roll them into higher prices to remain leveraged as the price increases. Once it achieves a runaway squeeze, which will be very easy to identify, you can start buying your lotto tickets. Too long didn't read. In my opinion, if you want to catalyze the squeeze, you will need to buy shares when the price is spiking and buy calls that are at least 10 to 20% in the money. So that is pretty darn, that's a pretty darn interesting war plan. If you guys are looking for a war plan that makes sense from a not so logical point of view, because therefore this is a game that has never been fought before and you guys are fighting it for the first time. A lot of these technical fundamentals that exist before that made sense for everybody and your forefathers and their forefathers no longer work for GME and AMC because they are now at the precipice of a game of knowledge, right? People know on both sides when the stock is going to peak and when it is going to dip. So that's why when they think it's going to peak, they decide to make it hurt. So we should make it hurt on our behalf. If this made sense to you, go ahead and comment down below which part you liked learning about most. And if you still have questions, go ahead and drop it in the comments and I will try and sift through and answer a couple of them. For now, I want you guys to see some of my coolest supporters. Over here we have the Moon Platoon right there, and over here the Space Legend, and finally the coveted Gorillionaire tier. Those all of you who have come and supported the show, I appreciate you greatly. And if you guys want to see your names up here for each and every video, then go ahead and click either the join button down next to the subscribe button or the Patreon link in the description below. Thank you guys for joining, and I'll see you in the next video.